Imagine starting your morning exactly like any other day. You walk into your local bank. Same counters. Same staff. Same calm routine. But when you ask to access your savings, the teller pauses and explains something unthinkable. Your money didn't disappear, it simply lost a third of its value overnight. No market crash. No emergency announcement. No inflation spike on the news. Just a quiet shift in how the rest of the world now values your currency. Your first reaction would be disbelief. That kind of collapse only happens in history books, or failed states. Not here. Not now. Yet that assumption is exactly what makes the current moment dangerous. Because currency power doesn't collapse with sirens. It erodes silently, until one day the damage is already done. As we move through 2026, a financial transformation is unfolding that most people haven't fully grasped. A group of countries representing nearly half of the world's population have begun settling trade through systems that no longer rely on the US dollar. China alone has redirected a massive portion of its international payments away from dollar channels. Trade between China and Russia, now exceeding $240 billion annually, is largely conducted without touching US currency at all. This isn't symbolic. It's operational. While alternative payment networks quietly expand, the US response has followed a familiar script, increasing borrowing, issuing more debt, and assuming global demand for dollars will remain permanent. But global finance doesn't run on assumptions. It runs on confidence. And confidence, once fractured, doesn't come back easily. This isn't speculation or theory. It's a measurable shift already underway, one that directly affects purchasing power, savings, and economic stability. What rarely gets discussed is that every dominant reserve currency in history has failed in nearly the same way. Different eras. Different empires. Same structural breakdown. I refer to this pattern as the reserve currency death spiral, a predictable sequence of decisions and reactions that gradually dismantles monetary dominance from the inside. The collapse never begins with panic. It begins with comfort. A leading power starts financing its influence not through productivity and surplus, but through borrowing. Debt becomes the engine of strength, because it feels limitless. Think of it like a credit account without an enforced ceiling. It works, until compounding interest quietly takes control. Once you understand this framework, today's global shifts stop looking random. They start looking inevitable. And more importantly, you can see exactly where the United States now sits within that cycle. Every reserve currency collapse begins with the same temptation: financing power through borrowing instead of production. At first, it feels harmless, even smart. When the world demands your currency, issuing debt seems painless. Money flows in. Interest rates stay manageable. Growth appears stable. That's where the United States has been for decades. But by early 2025, U.S. national debt crossed $36 trillion, a figure larger than the combined annual output of multiple major economies. This isn't abstract accounting, it's a structural shift in how power is being sustained. What matters most isn't the total debt. It's the cost of carrying it. The U.S. government now spends over $1 trillion per year simply paying interest, not reducing the debt, not funding services, just keeping obligations alive. That figure already exceeds the defense budget. According to Congressional Budget Office projections, interest expenses are on track to rise sharply over the next decade. By the 2030s, a significant share of federal revenue may be consumed before a single dollar reaches infrastructure, education, or public services. This is the moment history recognizes as the turning point, when debt stops supporting dominance and begins consuming it. When confidence in a monetary system begins to weaken, challengers don't revolt openly. They experiment quietly. That's exactly what's been happening. In a remarkably short period, China shifted more than half of its international transaction volume into alternative settlement systems. Not over decades, within a single year. Brazil and China formalized bilateral trade agreements allowing commerce without dollar settlement. India established specialized accounts enabling trade in local currencies with nearly 20 partner nations. These moves weren't framed as political statements. They were framed as efficiency measures. Yet taken together, they reveal something deeper: major economies reducing exposure to a system they no longer fully trust. Data from global payment networks shows the dollar's share of international transactions slipping year by year, while alternative currencies steadily gain ground. No dramatic collapse, just consistent erosion. This is how reserve currencies actually lose influence, not through rebellion, but through redundancy. Here's where the process accelerates. Once enough participants begin reducing reliance on a dominant currency, the system enters a feedback loop. Each step reinforces the next. As countries trim dollar reserves, demand weakens. As demand weakens, holding dollars becomes less attractive. As confidence drops, even more participants exit. This isn't ideology, it's risk management. Currencies don't fail because people hate them. They fail because people stop needing them. History shows that once this loop gains momentum, it becomes extraordinarily difficult to stop. Central banks respond with reassurance. Governments downplay the shift. But markets move faster than policy. By the time leaders publicly acknowledge the problem, confidence has already migrated elsewhere. The turning point comes when alternatives stop being theoretical. At a major BRICS summit in late 2024, member states didn't merely debate the future of global finance. They announced the rollout of a new cross-border settlement framework designed to operate independently of dollar-based systems. The initial phase connects a core group of countries, with expansion planned to include dozens more. Participation is optional, which is precisely the point. When a currency becomes optional, its monopoly is already broken. What makes this development significant isn't scale today, it's resilience tomorrow. These systems don't need to replace the dollar outright. They only need to function well enough that exclusion from dollar networks is no longer catastrophic. That's the strategy being deployed, not confrontation, but insurance. And once nations have reliable alternatives, dependence becomes a choice, not a requirement. When a reserve currency finally reaches its breaking point, the collapse doesn't unfold slowly or politely. It doesn't wait for decades of debate or gradual reform. It accelerates. What once felt stable suddenly unravels in a matter of months, sometimes weeks. Prices surge unpredictably. Savings lose meaning. Governments respond with emergency measures that only deepen public fear. This phase is where theory ends and reality begins. History shows that once confidence in a dominant currency fractures beyond repair, the consequences spill far beyond economics. Financial stress turns into political instability. Social cohesion weakens. Institutions that once seemed permanent lose legitimacy almost overnight. And perhaps most critically, the nation issuing that currency doesn't just lose monetary influence, it loses global relevance. Military reach becomes harder to sustain. Diplomatic leverage erodes. Cultural authority fades. Currency dominance is the foundation beneath modern power. When that foundation gives way, everything built on top of it becomes fragile. To understand how quickly confidence can vanish, we need to revisit Germany in the early 1920s. Before the First World War, the German mark was considered one of the most reliable currencies in the world. It was stable, internationally accepted, and anchored to gold. $1 exchanged for just over 4 marks, a sign of trust. That trust didn't disappear overnight. It was dismantled step by step. By late 1923, everyday life in Germany had become surreal. Prices no longer held meaning from morning to afternoon. Wages were spent immediately because waiting even a few hours meant losing purchasing power. There's a recorded account from Berlin in November of that year. A university professor ordered a cup of coffee at a cafe. While he sat reading his newspaper, the price of that same coffee rose before he finished drinking it. When he asked for a second cup, it cost significantly more than the first, in the same establishment, within minutes. This wasn't a fictional dystopia. It was daily reality. What many people misunderstand is the cause. The collapse of the mark wasn't simply the result of war damage. Germany emerged from World War I burdened by enormous debt and reparation obligations payable in hard currency. Confronted with an impossible fiscal situation, the government faced two options: raise taxes sharply and risk public revolt, or expand the money supply to delay the pain. They chose expansion. The central bank began issuing marks at an unprecedented pace, purchasing foreign currency at virtually any cost. The stated justification was to meet external obligations. Internal records later revealed a more cynical calculation, that destroying the currency might erase the debt tied to it. Once that process began, control was lost. Prices doubled every few days. Workers were paid multiple times per day because morning wages couldn't cover afternoon necessities. Retirement savings accumulated over decades were wiped out in weeks. By the peak of the crisis, a single US dollar exchanged for trillions of marks. Banknotes became so worthless that they were repurposed as fuel or recycled as scrap paper. But the most devastating damage wasn't financial. The collapse shattered public faith in institutions, laws, and democratic governance. Scarcity bred desperation. Extremist movements gained traction by promising order amid chaos. Within a decade, Germany's political landscape was unrecognizable. The currency was eventually replaced and stabilized with external assistance, but the psychological scars remained. Even generations later, German economic culture retained an intense fear of inflation, a collective memory shaped by watching money lose meaning in real time. For more than 300 years, the British pound sat at the center of the global financial system. During the height of the British Empire, it was the currency of international trade, banking, and trust. By the late 19th century, a majority of world commerce was settled in sterling. Holding pounds was considered equivalent to holding certainty itself. That dominance didn't collapse suddenly. It decayed. The first major fracture appeared during World War II. Britain financed survival and victory through massive borrowing, draining its gold reserves and foreign assets. When the war ended, the empire remained intact on paper, but financially, it was exhausted. By 1945, Britain owed enormous sums to the United States and Canada. The country that once underwrote global trade now depended on external loans just to stabilize its economy. The critical moment came in 1947. As part of a post-war financial agreement with the United States, Britain agreed to make the pound freely convertible into dollars. The logic seemed sound: transparency would restore confidence. Instead, it exposed weakness. Within weeks of convertibility, foreign holders rushed to exchange pounds for dollars. Britain's reserves drained at an alarming pace. The government was forced to suspend convertibility barely a month after it began. The signal was unmistakable: the pound could not defend itself without controls. From that moment on, sterling entered a long phase of managed decline. Over the next 3 decades, Britain faced repeated currency crises, multiple devaluations, and growing dependence on international support. Each attempt to preserve the pound's global role conflicted with economic reality. By the mid-1970s, Britain, once the financial anchor of the world, was forced to seek emergency assistance from the International Monetary Fund. It was the first time a major developed nation had faced such humiliation in the post-war era. The pound survived, but its status did not. Its share of global reserves collapsed from dominance to irrelevance. More damaging than the numbers was the psychological shift. Britain no longer saw itself as an imperial power, and neither did the world. A reserve currency doesn't just disappear. It fades, until one day, no one depends on it anymore. In the final years of the Cold War, the Soviet Union projected military strength, ideological confidence, and geopolitical reach. It possessed nuclear weapons, vast territory, and influence across half the world. But beneath that image, its currency was quietly unraveling. The Soviet ruble wasn't a global reserve currency like the dollar or pound. But within the Eastern Bloc, it functioned as the backbone of trade, subsidies, and political cohesion. Its value was inseparable from state authority. The foundations of its collapse were laid in the 1980s. The Soviet government ran persistent budget deficits to sustain military spending, subsidize allied states, and maintain an enormous bureaucracy. Rather than generate productivity, it relied heavily on energy exports, particularly oil, to bring in hard currency. That strategy failed when global oil prices collapsed in the mid-1980s. Revenues plunged. But instead of adjusting spending or restructuring the system, the government expanded the money supply to maintain the illusion of stability. Internally, officials understood the danger. Archival records show that by the late 1980s, Soviet planners recognized the same pattern seen in earlier currency collapses: excessive debt, monetary expansion, and evaporating confidence. They were trapped. Halting the printing would trigger immediate insolvency. Continuing would slowly dissolve the system. They chose delay. By the end of the decade, the official value of the ruble bore no resemblance to reality. A thriving black market emerged where the ruble traded at a fraction of its state-declared worth. Citizens understood their government was lying, and once that trust broke, legitimacy collapsed with it. The formal dissolution of the Soviet Union came in 1991, but the system effectively died earlier, the moment the currency lost credibility. Hyperinflation followed. Prices surged uncontrollably. Savings vanished. Pensions became meaningless. State assets were sold off at fire sale prices, creating a small class of oligarchs while millions fell into poverty. Life expectancy dropped sharply. Population decline followed. An entire generation experienced economic trauma that reshaped national psychology. This wasn't a gradual decline of empire. It was an implosion. One year, the Soviet Union was a superpower. The next, it no longer existed. And the lesson is stark: when a currency collapses, political power doesn't negotiate a soft landing. It falls with it. To understand where the United States stands today, the most important question isn't how much debt exists, it's how fast the system is moving. By early 2025, federal debt exceeded $36 trillion, placing the U.S. well above its annual economic output. In isolation, that number sounds alarming. In context, what matters is momentum. The country is now running trillion-dollar deficits during periods of relative economic stability. There is no world war to finance. No emergency mobilization. This is baseline fiscal behavior. According to long-term budget projections, annual deficits are expected to remain elevated for decades under current policy. As debt compounds, interest obligations grow automatically, regardless of political intent. Recent figures show interest costs rising faster than nearly every other category of federal spending. Within a few years, servicing debt is projected to rival or exceed the government's largest social programs. History shows that debt systems don't collapse because of a single crisis. They collapse when carrying costs crowd out flexibility. Once that threshold is crossed, policy options narrow rapidly. The danger isn't insolvency tomorrow. It's the loss of maneuverability over time. While Western debate remains focused on short-term policy, a quieter strategy is unfolding elsewhere. Across the BRICS bloc and beyond, central banks have been accumulating gold at a pace not seen in modern history. These purchases are not symbolic. They are systematic. Over recent years, a significant share of newly mined gold has been absorbed directly into sovereign reserves. China, Russia, and India now rank among the largest official holders, and their stockpiles continue to grow. Gold plays a specific role in monetary strategy. It carries no counterparty risk. It isn't tied to any single nation's fiscal decisions. And it retains value during currency transitions. This accumulation coincides with efforts to develop trade settlement systems backed by baskets of commodities and national currencies. Together, these moves form a parallel architecture, one designed to function independently if existing systems fracture. When central banks accumulate at this scale, it signals more than hedging. It signals preparation. They aren't betting on collapse tomorrow. They are ensuring survival if it arrives. One of the most underestimated drivers of de-dollarization has been the strategic use of financial sanctions. When the U.S. and its allies froze hundreds of billions of dollars in Russian foreign reserves in 2022, the action achieved its immediate objective: punishment. But it also delivered a message far beyond Russia. For many governments, the takeaway was simple and unsettling. Reserves held in dollars are not neutral assets. They are conditional. From that moment, countries began reassessing their exposure. Not because they opposed the United States, but because they recognized vulnerability. Surveys of central banks and emerging economies reveal a growing concern over sanctions risk. The response has been pragmatic rather than ideological: diversify reserves, expand local currency trade, and reduce dependence on systems that can be restricted by foreign policy decisions. Ironically, attempts to reinforce dollar dominance through coercion have accelerated the search for alternatives. Each sanction reinforces the incentive to exit. Trust is the true foundation of reserve status. Once currency use becomes a liability, confidence erodes quietly, but permanently. For decades, global energy markets functioned on a simple assumption: major commodities were priced and settled in US dollars. This structure didn't just support the dollar, it reinforced it. That assumption is now being tested. Across Asia, the Middle East, and parts of Latin America, energy exporters and importers are increasingly experimenting with non-dollar settlement. These arrangements often begin quietly: bilateral contracts, regional clearing systems, or partial payments in local currencies. Oil and gas are uniquely important because energy trade sits at the foundation of global demand. Every economy needs fuel. When energy transactions shift, currency flows follow. No single agreement overturns the system. But taken together, these deals reduce the automatic recycling of dollars through global markets. Less recycling means less structural demand. This isn't a rejection of the dollar. It's a gradual disengagement from exclusivity. And in monetary systems, exclusivity is power. At this point, critics usually raise three objections. First, the United States has unmatched military power. Second, it has the world's largest economy. Third, the dollar has survived challenges before. Each argument contains truth, and each misses the central issue. Military strength enforces security, not trust. Armies can protect trade routes, but they cannot compel other nations to store their savings in your currency indefinitely. Economic size helps, but it is not decisive. The British Empire remained economically vast even as the pound lost reserve status. Scale delays transitions, it does not prevent them. And history doesn't offer immunity. Every dominant currency in modern history, Dutch, British, and others, appeared unassailable until it wasn't. Reserve status erodes not when a challenger defeats the incumbent, but when the system supporting it becomes inefficient, risky, or politicized. Dominance fades quietly, then suddenly. Reserve currency shifts do not follow fixed schedules. But they do leave patterns. Between now and the early 2030s, the most likely path is not collapse, it is dilution. The dollar remains central, but its share of global trade, reserves, and settlement continues to shrink. Key indicators to watch include: expansion of non-dollar energy contracts, growth of alternative payment infrastructure, accelerated gold accumulation by central banks, rising costs of U.S. debt servicing. By the early 2030s, the system may reach a tipping point where the dollar is still dominant, but no longer indispensable. At that stage, the U.S. faces a new reality. Financing deficits becomes more expensive, monetary policy choices carry global consequences, and geopolitical leverage weakens. The transition won't be announced. It will be experienced. History rarely provides countdowns. It provides warning signs, and ignores those who dismiss them. Shifts in global currency dominance leave clues, subtle, measurable, and predictable. These are the patterns that signal change before it becomes obvious. Watch for central banks accelerating gold acquisitions beyond historical averages. Bilateral trade increasingly settled in local or alternative currencies. Growth of parallel payment systems like BRICS platforms. Dollar's share of global reserves slipping steadily below psychological thresholds. Each indicator alone doesn't signal collapse. Together, they map the trajectory of a system under stress. Being alert to these signs isn't panic. It's situational awareness. The difference between foresight and surprise is observation. The effects of currency transitions are not abstract. They land squarely on household balance sheets. Most Americans hold the bulk of their wealth in dollar-denominated assets, bank accounts, stocks, bonds, and real estate. If the dollar loses 15 to 20% of its purchasing power over 5 years, a modest historical shift, the average household could see tens of thousands of dollars in real wealth eroded. The top 10% are exposed too, but their access to global diversification, hard assets, and professional advice insulates them. The middle class, however, bears the brunt. Retirement accounts, savings, and property values tied to a weakening currency lose real-world purchasing power quickly. The lesson: the speed of adaptation matters as much as the size of the loss. 17. Objection handling, military size dominance. Reserve currencies do more than settle trade, they distribute influence. Consider the numbers. BRICS nations, collectively, now represent nearly 46% of the world's population and more than a third of global GDP, PPP. G7 countries, by contrast, account for just over 10% of global population, while representing slightly less than 30% of global GDP. If trade can be executed without the dollar, the network effects that once made it indispensable begin to unravel. A parallel system that handles even a portion of global commerce can undermine the incentive to hold dollars. Mathematically, dominance is not absolute. It erodes once alternatives reach a critical mass, regardless of tradition or perceived strength. Currency transitions follow a surprisingly consistent psychological arc. Observing it helps separate perception from reality. 1. Denial. The public assumes, "This time is different. Our currency is too big to fail." Confidence remains high, despite emerging cracks. 2. Elite awareness. Central banks and wealthy individuals quietly diversify. Small-scale adjustments occur, but public narrative remains optimistic. 3. Mainstream recognition. Media begins reporting on risks. Political leaders acknowledge problems, yet actionable responses lag. 4. Panic and flight. When alternatives are established and dollar dependency is questioned, capital moves rapidly. Protective measures become costly or unavailable to the average household. Understanding these stages isn't meant to induce fear, it's a blueprint. It shows where we currently sit, and how quickly ordinary people can find themselves exposed if trends accelerate. The history of currencies is clear. Collapse doesn't announce itself in headlines. It builds quietly, through predictable stages, until the impact becomes unavoidable. China, Russia, India, and other nations aren't winning, they're preparing. They are constructing systems to survive disruptions that history shows are inevitable when trust in a currency erodes. For individuals and households, preparation starts with understanding. Observe the signs, diversify intelligently, and avoid placing your entire wealth in a single, vulnerable currency. The goal isn't panic, it's foresight. Those who recognize patterns early can navigate transitions. Those who dismiss warning signs risk being caught unprepared, just as citizens in Weimar Germany, post-war Britain, or the late Soviet Union discovered too late. The question is no longer if a major shift will occur, but when it will happen, and how quickly it will affect daily life. The greatest illusion a declining currency ever creates is convincing everyone it is too big to fail, until the day reality proves otherwise. Will you be among those watching from the sidelines, or will you see the pattern in time to act? The choice is yours, and history shows there won't be a second chance.